let's just go and look at some of these main pairs then. First of all, we've got the euro. Chart on the top right, that's the euro. Happens to be the euro USD, that particular chart. But of course, it's the euro itself is traded against a good many other currencies, and it's been described as the world's second reserve currency. Now, what is a reserve currency? Well, quite simply, it's a currency that people keep in reserve, meaning that central banks will have a stock of them. You know, they've got reserves, and some of those reserves are going to be in euros. Now, a lot of those reserves are going to be in the US dollar, but of course, as the US dollar has just been collapsing over a good many years, say collapsing probably a slightly strong word, but as it's been moving south over a long period of time, and the euro has been gaining on the back of it, then central banks are just keeping them a good many euros tucked away. And indeed, there has been quite a good deal of world trade going on, particularly oil swaps going on with sort of Russia and so on, and they tend to keep their eggs in a couple of different baskets. Right. Okay. So structural problems north and south, and that could also cause a little bit of a problem as you guys have just discussed. Right. Now, next door to Europe, I mean, Europe, in terms of a trading bloc, is an enormous trading bloc. The Swiss have got a much, much smaller country, and they are independent of the euro, so they've kept their own currency. Now, one of the really interesting things is that the Swiss have got gold reserves, and they partially back their currency with gold. Consequently, a lot of people, a lot of investors like the idea of that, and whilst we've had these times of uncertainty, the Swiss have suffered very, very badly, and they've suffered because it's a safe haven currency. Okay, so if you're a little bit concerned about the US dollar and you've got a load of money in US dollars, then let's go and bung it into something which is a much, much safer currency, and that much safer currency would appear to be something like the Swiss franc. The only problem is that drives their currency up and drives their competitiveness down. Okay, it drives their competitiveness down. And of course, these two currencies are inversely correlated. Now, that correlation fluctuates somewhat. It's said to be around about 80% in the longer term, or 0.8 positive. And we have seen times when the Swiss have attempted to reduce the value of their currency against the euro, which is their major trading partner. They've attempted to reduce it by intervening and effectively selling, and selling their own currency to boost the euro. But it didn't work. It didn't work. Cost them an awful lot of money, and eventually they gave up. But the question now is the market actually doing the job for them? So there we are, two major currencies there in Europe, strong relationship between them. And then we've got the British pound. Now, the British pound at one time was an oil-backed currency, but of course that's going back a good many years, and the oil is largely now sort of running out. And of course the UK economy, which moved away from being the manufacturing powerhouse of the world, going back to the Industrial Revolution and beyond, is now completely changed to being a service-based economy. So we've got all sorts of invisibles that largely come from the City of London, etc. And one of the problems, of course, and this is one of the reasons that had a bit of a problem of getting into the euro, was that the country just runs a trade deficit. But of course, it is seen as independent of the woes of Europe at the moment. So now let's go on then to the Japanese yen. Now, this is one of the largest world exporters, very, very, very good at setting up all sorts of manufacturing bases in other countries, etc. And in terms of square miles, a relatively small country, but a very industrious one, However, the internal economy is really not bubbling along, which a good many commentators are putting back to loose money way back around about 20 odd years ago, and there were massive asset price bubbles, and these were the forerunners of QE. QE. Quantitative easing is something that Japan has indulged in, still got a major problem. Their tax take is less than the interest that they are having to pay out just on their QE, and they've got quite a few problems with their domestic economy. And it's an oil sensitive currency in that they've got to import every single barrel. Yeah, they've got alternative energies, they've got a little bit of nuclear, hydro, and so on. So there we are. Right, over to the Australian economy. Now, I haven't got the New Zealand in here, but the two actually go very, very close together. The larger of the two, of course, is Australia. And one of the real big things about Australia is that they produce gold. They've got a whole stack of gold, which they produce. I'm not quite sure of the numbers, but I think it's something like 6 or so billion per year exports of gold. And the economy has been very, 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 very strong. In fact, so strong that it has shown some signs of bubbling over. I mean, for instance, all of those little indicators of domestic economy when house prices end up getting to be such a high multiple of average earnings that people can no longer afford to buy them. All of that stuff happening in Australia. And they've always had consistently high interest rates, as have the New Zealanders, and consequently yeah, absolutely right, yeah. And consequently, the New Zealand dollar and indeed the Aussie dollar has been a real favourite of the carry trade with the JPY. Right, okay, so, and we can't leave out the CAD, the loonie, which has got a double whammy. It's an oil producer, and as time goes on, technological advances means that oil and gas can now be extracted from oil shale, of which they had loads and loads of these shale and tar sands, which they didn't know what to do with 10 years ago. Now they found ways of actually extracting the mineral, the oil from it, and so it's a very, very strong oil economy. Now, the consequence of that and gold is that if oil and gold are going up, then what is likely to happen to the CAD, assuming that everything else remains equal? Their major trading partner, because they're immediately next door, and the fact that they've got so much oil, and the US has got an enormous appetite for oil, then what we're going to find is that they are totally dependent. Round about 80% of their exports go into the US, and a little comment there, Roger, going back to the UK and Ireland, well, there is a fantastic amount of trade between the UK and Ireland. In all sorts of ways, from basic agriculture to all sorts of services. But yeah, there is that very, very great dependence on the US. So just by getting a handle on these last few slides, these last few aspects, you can start to sort of build up a picture and create an awareness that something is going to, what's going on with a commodity or a particular country is going to affect the exchange rates